nature. So, this will be, catered towards anybody who's new to fixed income as a whole. So that being said, let's jump right into it. So today we will be covering what is fixed income. We'll cover some key terms, some common types of bonds, the role of fixed income, some bond math involved in bond pricing, yield and price and its relationship. We'll cover yield curve and duration risk. We'll cover the difference between fixed and variable rates, and also credit ratings and agencies, elements that move bond prices, and finally, we'll get to some basic fixed income strategies. And before we begin, I actually wanted to take a look at this chart here. Global capital market sizes in 2021 was roughly $250 trillion, and we see that fixed income remained, just above the equity market in size. And some of you may be surprised at this, others not so much, but I wanted to really illustrate just how big this asset class truly is. And of course, how important it is to the overall health of the financial markets. And also I wanted to take a look at some important fixed income figures, some famous guys in the space. And the reason why I want to do this is, really to highlight the potential in this space, right? So typically we see fixed income as, an asset class for boomers, guys who are close to their retirement age and, guys that just buy and hold bond. And, while this is a large subsection of all fixed income participants, this is not the only method of using this asset class, right? Howard Marks, David Tepper, Michael Platt, these are some quote unquote, household names within the space. And they've all done pretty well within their own niche sections of fixed income, right? So Howard Marks is a famous person who founded Oaktree Capital. He's very known for distressed debts. Michael Platt as a hedge fund trader. He's very short-term oriented. Last year, we returned 153%. And of course, David Tepper, hedge fund manager of Appaloosa, also focused on distressed debts, high yield debts, the sorts, right? And really, to think that only you can achieve low returns in fixed income is really false. And because it's actually a space where a lot of your due diligence, especially hardcore due diligence, is rewarded, and it can really be a lucrative space. So it's just something to think about. But that being said, let's get right into it. So fixed income, what is it? On a high level, fixed income or bonds are IOUs, right? They are contracts between a borrower and a lender. And a borrower issues bonds to raise money from lenders with a specific duration and a promise to pay a specific interest rate during its lifetime. And once the bond matures, this principal borrowed must be returned to the lender. And generally speaking, corporations, governments, these are the majority issuers of fixed income, right? But of course, another common issuer is also the home buyer, as banks are the ones who buy up this debt. So, but furthermore, there's something called the covenants, right? And an investor may also require the borrower to maintain some of these covenants throughout the lifetime of a bond. So, what are they? And just to keep things simple, they're just extra requirements that the lender demands from the borrower, right? So if I were to, lend some money to Anthony, but Anthony's credit rating is a bit shady, I'm going to say to him, look, I'll lend you the money, but I need you to hold a certain amount of cash on hand so that I know that you're liquid, right? So that's an example of one of many covenants that a borrower and the lender can negotiate on. But just something to keep in mind for fixed income. Of course, in terms of bond convention, normally we speak in terms of basis, right? So 1 basis point equals 0.01%. 100 basis points is 1%. So some important terms were mentioned just in the previous slide. I'm going to quickly cover over them. So maturity dates, what is that? It is basically the time when the bond issuer must return the money it borrowed to the bondholder, right? So after maturity, the bondholder will no longer receive bond payments, right? They're no longer going to receive interest payments. But one thing to note is typically bonds do not exceed a maturity of 30 years. But of course, as with most things, there are exceptions. And some companies like Coca-Cola have issued 100-year bonds in the past. Face value. This is basically, the value that a bondholder will receive at maturity. So bonds are generally in denominations of $1,000, right? So, if I were to, issue $2,000 of debts at $1,000 denominations, there will be 2 bond certificates, right? Just 2,000 divided by 1,000 equals 2. And of course, this is a denomination that's just standard practice. It doesn't have to be that way, depending on what the lender and the borrower again negotiates on. The face value can change depending on what they want, right? Principal. This is basically the total amount of money that the bond issuer is borrowing, right? So very straightforward, very simple. You borrow $5,000, your principal is $5,000. Very simple. Coupon rates. This is the amount of interest that is received from the bond relative to the face value. As this term suggests, this is a percentage format, right? So let's take an example of $50 per year in interest on a face value of $1,000, right? You just do 50 divided by 1,000 equals 5% coupon rates. Now, going to yield, it's a bit more involved. This is the expected annual return until maturity. And, there's a little bit of a complicated formula, but we're not going to really touch on that because it's generally speaking, a lot of the bond websites will do this math for you. But basically, we want to add up all the bond payments and price appreciation that we would expect, and then divide this by the average of the face value and price. Now, next slide. And within the bond market, there are multiple categories of bonds, right? But some of the more common categories you can expect to see are government securities like US Treasuries, or debt issued by other major countries like Canada, Japan, UK, France, Germany. There's also municipal bonds like the province of Ontario, city of Toronto, like the more localized municipalities compared to government securities. You also have corporate bonds, bonds that are issued by companies like Apple all the way to, some small random company in, Minnesota or something, just random example. Mortgage-backed securities, very straightforward. It's, debt related to real estate purchases, and of course, emerging market bonds. So you might be wondering, why is emerging bonds different than government securities or municipal bonds or corporate bonds? And there's a good reason for this, actually. Typically speaking, emerging market bonds are much more risky, therefore they have higher yield. Okay, and then why is that? Well, it's because generally speaking, these countries are not very well developed. And so as an investor, you are carrying much more risk, and there's a higher chance that they cannot pay you back for the money that they borrow from you. And some of these countries like Sri Lanka, Lebanon, Argentina, Egypt, these guys all defaulted in 2022 and have not been able to pay back their investors in earnest, right? And so because of this sort of dichotomy, we have to really separate emerging market bonds from the rest of the group. And, it's very necessary to have them in their own little section. Right. And typically, the average investor purchases its bonds from the secondary bond markets. Right. So the primary bond market would be where the cash is given to the bondholder. If I were to exchange, let's take me and Anthony again, for example. If I were to borrow money from Anthony and I were to issue a bond certificate to him, that's a primary bond market. If Anthony were to take these certificates and go to market with them and exchange hands with other people, that would be a secondary bond market. So typically, we as investors are buying from the secondary bond markets. And let's look at the role of fixed income, or in other words, why anybody would want fixed income in their portfolio, right? Compared to equities, obviously has a lower annual return, and it's really, it's not as appealing, right? But for a passive investor, for the buy and hold guy, it's actually quite useful. There's several reasons here. So first one is that bonds give diversification in a portfolio, right? If you only hold equities and equities happen to underperform in a given year, bonds can help insulate your portfolio in that sense, right? Diversification is a very, very useful useful tactic for situations like that. So diversification is number one. Number two is that fixed income can act as a store of value for market participants, right? So maybe, if you are a stock picker, right, and you have some cash laying around, you can hold cash, or you can park your money in some short-term bond, right? And the question is, why would you do that? Well, simply because at least with bonds, short-term bonds, you get some interest payments. And these small interest payments will help insulate against the erosion of inflation, right? And so, you're given periodic payments, whereas cash just doesn't. Cash is just cash. It stays in your portfolio, does nothing for you. At least with bonds, you are protecting yourself somewhat from the effects of inflation. Right. And this also feeds into the next point, where bonds offer predictable cash flows for investors who prefer less risk, right? Some investors like the predictability of cash flows, and it gives them a lot of peace of mind. And, this predictability allows people to better budget and plan their monthly expenses, right? And finally, another reason why bonds might be useful in an investor's portfolio is because bonds are less volatile than other asset classes. Again, peace of mind, right? The predictability. And bonds can help essentially dilute risk and manage your portfolio's volatility, especially for those who don't like seeing their portfolios go up and down 10, 20%. Maybe it's too much for them. Bonds can help with this peace of mind. Now, in terms of some active strategies, as a trader, we commonly use fixed income when representing macroeconomic views, right? So for instance, if you are a trader and you wanted to bet that the US Federal Reserve would increase interest rates, which asset class would you use? You can use equities, you can use commodities, you can use currencies, but interest rates would be best suited with bonds and fixed income. And so this is one of the many examples where we might want to use fixed income for macro views, right? And so feeding into the next points, for a lot of these big hedge funds, for a lot of these big institutions, liquidity is key, right? They need to be able to scale in and out of these hundreds of $million positions really quickly and at a cheap cost. Right, bonds are very, very liquid, and they give you the sort of movement that you need in order to make trades. Right, and so a lot of equities don't even trade hundreds of millions of dollars worth of volume every single day, but a lot of bonds, especially U.S. Treasuries, can withstand this type of volume, which is why it's so important and why bond traders and macro traders really love using fixed income. Now let's get into a little bit of math. Bond pricing. Knowing how to compute essentially fair value for a bond is very important, especially as you primarily deal with cash flows, right? And so price is computed as the present value of interest collected throughout the lifetime of the bond, plus the present value of principal at maturity. So applying this definition, we need to find the present value of each interest payments along with the present value of the principal at maturity, right? So we compute each output separately in this table, and then we combine them for the fair value slash price at the bottom, which comes out to 99.46. Using this PV formula right here, we apply it in this column right here. So in this next slide, let's cover yield and price. And the relationship between yield and price is a very important concept to understand as a fixed income participant, right? So very simply, yield and price has an inverse relationship and is balanced with the bond's coupon rate as seen in the diagram here. And the reason for this is because coupon payments can never change. Only the price can change. So then if we think of a coupon payment as something like $5 for an annualized annualized interest payments, so the coupon payments as $5 and then setting the price at $100, the coupon rates would be 5%, right? But let's say price went to $110, right? So your numerator is still 5, your denominator is now 110, and then you do the math. Let me do the math. It's 4.5%. Roughly. So the yield changes, but the coupon doesn't, right? So as price moves, yield moves as well, right? And so you have this inverse relationship that you see in this little neat chart here. And it's a very important concept, especially for fixed income traders, right? So now looking at the yield curve a little bit, this is a very important graph, and it's used frequently to gauge risk as well as the expectations of many market participants, right? So an inverted yield curve would suggest that market participants are selling short-term debts because they have a dim outlook on the short-term economy, and they are buying up longer-term debts because they think that in the far future, the economy will recover and that they will be paid for holding this longer-term debts, right? But in the short term, they're not very happy, right? They're not very sold on the economic sort of outputs in the short term. So remember how we talked about yield and price, how when price moves up, yield comes down. When price moves down, yields come up, right? So essentially, we can apply to here as well, right? So, when we see that the yield curve goes from a normal curve into an inverted curve, we see market participants essentially bidding up the later maturity bonds. Look at the yield here, 4.8%, bidding it up to a rough yield of 2.2%, right? Whereas the short end is sold off, going from 2% all the way up to 5%, right? So again, holding coupon payments equal, price has to move in order for yield to move. So when the yield curve is, trending down, that's something we have to look for. And of course, an inverted yield curve is no good because it's a strong predictor of potential recession, or if when we're looking at a normal yield curve, it can predict a strong recovery, right? And as we always say, the bond market is rarely wrong. They are one of the most accurate ways of predicting sort of future economic growth. So let's look at duration risk a little bit. And again, this builds off of previous slides, right? So duration is the weighted average of the present value of a bond's cash flows and is typically expressed in years. And it provides sort of the approximate change in price that any given bond will experience for each 100 basis point move in either direction. So let's look at these examples really quickly. For a bond with a duration of 1 year, an increase of 1% in interest rates will cause the price of bond to fall by 1%. For a bond with duration of 10 years, a decrease of 1% in interest rates will cause the price of the bond to move up by 10%. And so if you notice this chart at the bottom, interest rate risk is highly correlated with bond duration and is inversely correlated, right? So again, if interest rates increase, your price falls. But by how much, right? 1% equals 1 year, technically. So, if it's 10-year duration, if it's a duration of 10 years, you're going to see a move of 10% for every 1% change in interest rates. So that's duration risk. So now looking a little bit at fixed or variable interest rates, over 2/3 of all bonds are issued in fixed rates, with the remainder in variable interest rates. So the question might be like, why might a lender choose one over the other? Like, what are the benefits? What do we have to consider? And that's an important question, right? So, just as a quick refresher, fixed interest rates are when interest payments are fixed throughout the life of the bond and it never changes. Variable rates are when the interest rate payments change depending on the country's interest rate, right? So, let's look at some points here to consider. I won't really call them pros or cons, as they can act as double-edged swords, but important to look at nonetheless, right? So for fixed rates, you have certainty in interest payments received, and as a lender, this is very valuable to you because you know what to expect every single 6 months, year. You know how much money you expect to come in and at what periods and interval, right? You also can benefit from falling interest rates because bond prices will rise accordingly, right? But you won't. But you really lose out on on rising interest rates because you can't adapt to those. You're stuck on your fixed coupon payments, but when interest rates rise, you can't take advantage of getting those bond payments, right? So for variable rates, we see here it's a good method of diversifying debt holdings, particularly because most debt is issued in fixed rates. So, holding some variable will give you some sort of diversification. And variable rates also benefit from rising interest rates, but of course loses out on falling interest rates, right? When interest rates rise, your variable debt gets paid out much more. When interest rates fall, your variable debt receives less interest, right? So that's a risk you have to consider. And since, bond payments depend on these interest rates, when interest rates fall, you receive fewer dollars, and ultimately there is less certainty with variable debts. But it's up to the investor to determine this risk if they want to take it or not. So again, there is risk. There's pros and cons for both sides. There's many things to consider, but depends on what they want, right? So, looking at the current interest rate environments, would you feel comfortable holding variable rates? And perhaps when might variable rates be more favorable than fixed rates, right? So these are some questions that would be helpful to answer and to see if you truly understand, when one might be better than the other, especially for an environment like this. If you held a mortgage from 2020 until right now at a variable rate, you'd be screaming and you'd be in pain right now. I mean, seeing your interest payments and mortgage payment every month go up like 50%, 100%, that's brutal, right? But, the question is, what if we didn't get such a quick interest rate hiking cycle, right? What if rates stayed low? Then fixed income would obviously not be as beneficial, right? Because variable rate will be at a much lower rate and you'll be paying much less, right? So, you really have to think about like what's the trajectory of the interest rates and what the central banks are really planning in terms of raising or dropping interest rates in the future. So now let's look at credit ratings and agencies. And credit rating agencies are responsible for rating the creditworthiness of a borrower based on many criteria. Some that we really look at are company cash flows, balance sheet ratios, overall liquidity, and also financial forecasts, right? So Moody's, S&P, and Fitch are the dominant sort of credit rating agencies with over 95% of all credit ratings performed by these companies. The rest are by much smaller localized businesses, but these are the main ones that everybody should know of, essentially. And looking at the chart at the right, typically the BB plus equivalent rating or lower is considered high yield or junk, right? These are companies with higher risk, but investors are compensated with higher yield, right? They have to be paid for the risk that they're taking. And anything above would be considered investment grade, right? Investment grade would mean that you are worthy of investments, and you are much less risky. You have lower yields compared to high yield debts companies, and yield increases as we go down the list. Compare AAA to something like a BB plus. AAA would be something like like an Apple or something, right? Like some company that's really, really well positioned. Whereas another company that might be like a junk grade might be something like, I don't know, Bed Bath and Beyond. Probably they're much lower, but Bed Bath and Beyond, one of the more junky companies out there. So yeah, so let's let's look at what moves bond prices. So going back to the credit rating slide, one of the more common ways to move bond prices is by upgrading or downgrading the credit rating of companies, right? So credit ratings, of course, determine how much your bond should be yielding, and these credit ratings are very important to the overall health of the bond market, right? So changes in company fundamentals and outlook, changes in credit ratings, these are fundamental things that would affects the overall sort of sentiment around a certain company, and it can work both ways, of course, up and down. In terms of interest rate cuts and hikes, as we've mentioned before, coupon payments are fixed, but what changes when interest rates increase or decrease are the price, right? So, these bonds that exist cannot increase in coupon payments unless they're variable. Generally, they're fixed, right? So, in the sense that when interest rates rise, the prices of existing bonds typically fall, and the other way works as well. So, we have to watch the Fed and the central banks very carefully to see what they're planning to do with interest rates, to know sort of how to position ourselves with the debts that we hold, so that we're not caught with debt that's worth much less than what we paid for, right? And just keeping tabs on the macroeconomic environment is very important, which feeds onto the next point. Macroeconomic data moves bond prices a lot, and there are some examples that I list here, but there's much more that exist. So one of them, let's actually look backwards here. Let's look at inflation first. So why would inflation move bond price? It's because high inflation really causes bonds to sell off due to the fact that it's going to give the Fed and central bank more reason to increase interest, right? Because the central bank aims to lower interest rates to the 2% range by increasing interest rates to an acceptable level. And they're going to keep doing that until interest rates fall, technically. And so, when inflation runs hot, there's a really high risk of increasing interest rates. And as we just saw, increasing interest rates is not good for our bond prices, and that's what causes bond price to move. Another macro data point that we look at is unemployment report, right? So, the U.S. Department of Labor reports this every week with two key data points that we want to look at, right? So we want to look at initial claims and continuous claims. So initial claims basically refers to the workers that basically applied for unemployment benefits, for the first time since they got laid off. And of course, continuous claims would be people who are continuing to apply. And this is very important because a strong economy requires, a very strong labor, right? And but it's very important that this data doesn't run too hot. And what does running too hot mean? It's bad to say, but we don't want to see unemployment at zero and initial claims at zero, because when everybody's working, that's when everybody is employed, like close to 0% unemployment rate, there's a very high chance of causing inflation to run hot. It's terrible to say, but as economists look at this, it's a typical full employment percentage would be around 4%. The maximum unemployment that we can accept, or the minimum unemployment we can accept, is roughly 4%, right? Anything lower tends to make the economy run too hot, right? And so, but we don't want unemployment claims to be too high either, right? We want a sort of a Goldilocks amount where, data isn't running too hot or too cold. We want just the right amount. And this perfect amount will basically keep bond prices high and keep the market very content, because they think that the economy is still running very healthily and not running too hot or too cold. And then looking at non-farm payrolls, this is basically data that looks at how many people are employed in the US. And this is a monthly report that is released at the end of the month. And as the name suggests, it is a report that excludes farm-related hiring. And it's very important because non-farm payrolls basically give a direct insight to sort of the economic data such as GDP, right? We get to know exactly how many people are working, and we can sort of extrapolate this data and to sort of predict future growth. And what we do with this data is we try to look at the month-over-month change, and we try to extrapolate whether, certain trends in unemployment or employments are happening, good, bad, or otherwise, right? So if non-farm payrolls is showing that, there's a declining employment consistently over a few months, that's a not very good sign, because it could show that the economy is not as healthy as we thought. It can show that perhaps it's starting to weaken. But also, if there's too many people employed and always beats consensus, perhaps it's gonna run too hot. Inflation is gonna come in, and obviously, as with the inflation and the interest rate, that's gonna bring bond prices down as well. So again, this economic data that we're looking at can move bond price. And finally, we look at market liquidity and quantitative easing and tightening, right? And so market liquidity is very important to bonds, and it's not unique to equities or any single asset class. Liquidity is very important for basically price action, right? But not to go too in depth, but sort of intuitively, you can think that you need liquidity in order for motivated buyers and sellers to match at healthy prices, right? If there's no liquidity, the spreads will be too much, right? So an example of a lack of liquidity could be like only one buyer and one seller for a certain good, right? So perhaps a buyer comes in with a bid of $90, a seller comes in with an ask of $110. The spread of $20 is very, very wide and indicates a lack of liquidity, right? So ultimately, either side has to give in, or like both sides give in completely, and we meet at the middle, $100, or alternatively, if there's more liquidity coming in, we get a more accurate view of the price of a certain asset, right? And so ultimately, liquidity is very important for bonds as well. And I mentioned here quantitative easing and tightening. This is a central bank phenomenon or operation that has been occurring for a couple of decades now. But basically, quantitative easing is what people think of as the Fed printing money, right? So quantitative easing you can think of as the Fed or the central banks going into bond markets and outright purchasing bonds to push liquidity up, right? So they're taking, cash that they make up, and they exchange that cash for bonds that they hold on their balance. And this cash that they release into the markets will help pump liquidity and help give sort of life to the financial markets. And alternatively, quantitative tightening is when the Fed and central banks do the opposite, right? They take the bonds that they hold, they sell it back to the marketplace, they drain out liquidity so that the financial markets aren't overzealous, or to stop the markets from being overzealous, right? And so quantitative easing and tightening, very important to note, but generally speaking, during quantitative easing periods, there is a big boom. During quantitative tightening periods, there is a little bit of a bust because of the liquidity sort of interaction. Now, we get to our fixed income strategies now. So we'll look first at the passive strategies. There's three that I list here. So first one is a barbell. You want to use this strategy basically if you are long the short end and long the long end of the curve. And you want to use this when typically short-term yields are high, such as right now, right? Like if you look at the US yield curve, the 1-year yields are roughly 5%, which is very high compared to historical averages. The last time the 1-year yield has hit 5% was in 2007. So, you can think about, bonds really haven't had this type of yield for a long time. Right. And so the short end, you want to use barbell when you want to take advantage of the short end of the curve, but also you think that the long end of the curve, such as the 20 years or 30 years, have a decent yield, right? And that's because you want to lock them in. And so, you see here, like you buy 1-year treasuries or you buy 10-year treasuries, you're locking in both ends of the curve. And the strategy gives you diversification of duration risk because you're not overly allocated towards either a maturity, right? So that's a strategy that you can use in a period like this, right? Once the 1-year treasuries expire or mature, you can literally just roll these into the next 1-year bonds, or you can roll them out into the 10-year treasuries that you hold. There's a lot of ways you can carry the strategy out. But of course, a concern you might have is like, what if interest rates continue to rise when I'm in the strategy, right? I'm holding a lot of long-term bonds, I'm holding a lot of short-term bonds. Like, what gives, right? And so, this is where the short-term end of the strategy really really shine. And because when your short end maturities mature, by that time, interest rates have risen. You can take this money and you can re-roll them into newer short end maturities, or you can take this and roll them into new long end maturities, which will let you lock in an even better yield, right? And so, there's ways to play both sides, of course. And ultimately, even though your long end is going to suffer a little bit, the risk is ultimately diluted if you roll your short end into the long. So looking at the ladder now, this is a strategy where you long all maturities at different weightings. So you see this little diagram here, you're buying at every single interval basically. And, why would you use this strategy? And the reason is, for periods like this, a lot of people are holding a lot of cash, right? They don't want to jump into the markets. They feel that it's too early for them, and there's perhaps more downside for X, right? So they're holding a lot of cash. But they've probably also noticed that a lot of banks and GICs are yielding pretty well, right? But the question is, do you throw all of that money into short-term GICs, mid-term GICs, long-term GICs? What do you do? Or even with U.S. Treasury, you can do that with U.S. Treasuries as well. But ultimately, it is a tough call. But one of the more surefire strategies is just laddering out, such as here. You buy 20% in the 6 months, 20% in the 1 years, 3 years, 5 years, 10 years, and ultimately laddering them out like this will protect you against interest rate moves and give you more optionality as time passes, right? So 6 months down the road, it doesn't really matter if interest rates increase or decrease. By that time, you've already unlocked a portion of your money, and as you continue progressing, you'll unlock even more of your money that you've allocated to these bonds and GICs, right? So there's a lot of optionality here. Now, the question is, ladder and barbell are quite similar. So, what's the main difference, right? When would we use each one? For the barbell, mainly you're doing this to lock in short-term interest rates, and you're comfortable with the long-term interest rates that you're seeing, right? But for the ladder, right, you don't really have an opinion, and you really just want to diversify, and you want less exposure to long-term interest rates, right? Because here on the barbell, you're putting much more on one end and the other end, rather than diversifying it in equal sort of manner. So barbell does give you more risk on the long-term duration risk, but if you're comfortable holding that yield, it's not that big of a deal, I would say. But ladder is much more diversified. And of course, a final strategy would be just fixed allocation in a portfolio using some ETFs, right? If you're a 60-40 investor, 60% of your portfolio is in equities, 40% in bonds. All you're doing is just buying bond ETFs to just dilute the risk of the equity holding that you have. So that's the passive side. And now looking at the active side, first strategy here is distressed debt investing, right? So as I mentioned with Howard Marks and David Tepper, these guys really specialize in distressed debts investing. And the strategy involves purchasing debts from companies that have a high risk of default in a hopes of a rebound in price, right? So, you're not necessarily playing the bond payments here. You're playing the idea that the bonds are really oversold, and you're hoping that the bond prices just rip up and you can just sell when that happens, right? So, but this is obviously a more risky strategy. So you have to know your stuff very deep. So some questions you might want to consider, right? Does the defaulting company have a good plan to, turn the ship around? Do they have a good solid business plan that they can work off of? Do they have a path of recovery for their balance sheets and for their cash flows? Is it likely that the credit rating agencies such as S&P, Moody's, and Fitch, are they likely to upgrade the debts of this company in the short, right? Is the management team competent? Well, probably not, considering that they're in this type of environments, but is the management competent enough to turn the ship around? And so there's a lot of questions that you have to ask, especially as a distressed debt investor, because there's a very high risk of defaulting. But if you choose your fights wisely, there's a high chance that you can make out in the long run, right? So that's why some of these guys have done very well in the past. It's just that their due diligence and their attention to detail is just very, very strong. And their ability to basically ask the right questions and scrutinize basically small details is very, very good. So now looking at credit analysis, the strategy basically uses fundamental investing strategies for equities to determine investing opportunities, right? So you can almost think of this as just equity research. There's not much of a big difference. ultimately you are still using a lot of the same strategies, such as, reading their financial statements, reading their growth path, reading, whether the management team is competent. So yeah, like very basic stuff. A lot of the stuff that you already do in your equity analysis sort of journey, basically. But these two strategies sound very similar, and to a certain extent it is, right? So, but fundamentally speaking, the main difference between distressed debt and credit analysis, I would say, is that distressed debt is a much more niche segments. You're looking at strictly companies that are basically going belly up, looking for a last hurrah, whereas credit analysis would cover a very broad range of companies in terms of industries, credit rating, financial ratios, all that stuff, right? So credit analysis is much more broad in nature. And of course, final strategy using macroeconomic analysis. We use macro data to speculate on interest rates and bond prices. Because this is a nature of very short term, very like market liquidity base, we want to be using a lot of data that can basically turn the tides and make the trade a successful trade for us, right? So, as I mentioned before, like the non-farm payrolls, the inflation readings, the unemployment report, these are all data sets that we can use in order to make a trade, right? So let's say a couple of days ago there was a CPI reading, right? CPI reading from the US. If we were a bond trader, we could say like, look, we think inflation is actually much higher than what the street thinks. So, we'll set up like a bond short, and that's one of the many strategies you could run, right? And so, macroeconomic analysis really is a short-term oriented trade. But that being said, I will now enter the Q&A, and yeah, I think that's it for presentation for now.
Fantastic. Thank you very much, Nick. Really enjoyed that presentation. Again, for the audience, this, it's hard to capture fixed income in sort of 1 hour, but the point of this was to sort of give you a window into the world of fixed income. And we're here present, so ask as many questions as you can, take advantage, and we'll get started on the Kahoot right after this Q&A session. Yeah, feel free to unmute yourself or put it in the chat if you'd like. But in the meantime, while people are thinking of questions, I guess, what's your current commentary on the current one?
Yeah, it's a bit tough right now because we don't know whether or not inflation is really going to head back down to 2% in a linear fashion, and of course the jobs market is still showing conflicting data, and so the bond market really is trying to price in a soft/hard landing / no landing at all, basically. And with rates recently moving up to 5% for the 1 year and the 6 month, it's not a good look, especially when bonds are really deviating from the equity moves, right? Like bonds are selling off while equities are moving up. One of them have to be wrong. But as history has shown, bonds are generally not wrong, and equities are perhaps, dare I say, maybe a bit excited right now, maybe a bit overzealous about potential growth in the next 6-12 months. The bond market is saying that, it's not going to be as easy as what the equity markets think. The equity markets think that, corporate earnings are going to stay high and, we're not actually going to get much of a recession. So, who knows, right? It's a really tough call right now.
Yeah, it's really at a historic point in the bond market where, what is it called again? The spread, 10-2 spread.
Yeah.
It is 10-2 spread. Yeah. Well, when it inverts and, it's at its lowest full decade.
Yeah.
Very interesting to see what's happening in the market. Good time to be alive.
Good time, never a better time.
Yeah. So I don't see any questions in the chat, so I guess we could just jump right in. Anthony, if you want to stop the recording just to capture it all, do that and go ahead.